Hello everyone, I'm CA Neeraj B. Welcome back to my YouTube channel at the rate Accounting Buddy NB, your go-to place for mastering the fundamentals of accounting. In today's lesson, we are diving into one of the core pillars of accounting, the ledger. If you are wondered how businesses keep track of every transaction in an organized and accurate way, this video is for you. We will cover everything from the meaning and the purpose of ledger, its format, and how entries are posted from the journal, to balancing ledgers and understanding the difference between the journal and a ledger, and how it all leads to preparing a reliable trial balance. Whether you are a student, a professional brushing up your basics, or just someone curious about how accounting works behind the scene, this lesson will give you crystal clear insights and practical examples. So relax, grab a seat, hit the like button, and let's break down the word of ledger. Let us understand the meaning of the term ledger. A ledger is a primary book or digital record that contains classified and summarized financial transactions of a business. It serves as a foundation for preparing financial statements. Every transaction recorded in the journal is eventually posted to the ledger under the respective accounts. All the accounts put together make a ledger. Ledger is a book in which various asset accounts, liability accounts, capital accounts, revenue accounts, and expense accounts are opened and the transactions are posted in the respective accounts from the journal book. Trial balance is drawn from ledger, and from trial balance financial statements are prepared. Hence, ledger is called the principal book of account. Let us now learn the features of a ledger. First feature of ledger is related to classification of transactions, which means business transactions are recorded under different account heads such as cash, sales, purchase, expenses. Ledger accounts summarizes the effect of transaction upon assets, liabilities, capital, income and expenditures. Second feature is related to double entry system. Each transaction is recorded with a debit and a corresponding credit entry. It is prepared from journal. Another important feature of ledger is related to the summarization of financial data. It helps in summarizing all the transactions related to a particular account. Another important feature of ledger is balances and adjustments. After posting all the adjustment entries, ledger helps in determining the closing balance of different accounts. Next feature of ledger is that it is a permanent record. It serves as permanent record for all the financial transactions. Another important feature of ledger is that it is the basis of financial statements. The balances in ledger account are used to prepare the financial statements like profit and loss account and balance sheet. Let us learn the utilities of ledger. It provides complete information of a particular account. All the relevant information relating to a particular account is available at one place in the ledger. It provides information of income and expenses. In ledger, a separate account is maintained for income and expense. The amount of total income and total expenses are known from the ledger accounts. Ledger helps in preparing trial balance, which ensures arithmetical accuracy of the transactions recorded in the books of accounts. Ledger is also helpful in preparing the final accounts. After preparing trial balance, final accounts are prepared to know the profitability and the financial position of the business. Let us learn about the T account format and the information which is captured for each transaction in a particular account. There are four columns on each side of the T account. They are date, particulars, journal folio and amount. In the date column, the date of the transaction is mentioned. In the particulars column, the name of the other account is mentioned. In the journal folio column, the page number or the reference number of the journal book or the subsidiary book is mentioned where the entry was first recorded. And in the amount column, the amount of the transaction is mentioned. Left hand side of the T account is the debit side, and similarly 4 columns are there on the right hand side of the T account, which is the credit side. Remember, if a transaction is affecting the debit side of an account, the details will be filled on the left hand side of the T account, and if it is affecting the credit side of an account, the right hand side of the T account will be filled. Further, the name of the account is mentioned on the top of the T account together with the period for which the transactions are recorded in a particular account. To sum up, below mentioned points should always be remembered about T account. Name of the account along with the period is mentioned on the top of the T account. Account is divided into two identical halves. Left hand side is called the debit side. In short, it is written as DR. Right hand side is called the credit side. In short, credit is written as CR. Now, depending on the effect, an entry will either be written on the debit side or the credit side of an account. Let us now understand the concept of posting of entries. The process of transferring the transactions written in the journal to the ledger is called posting. In other words, the process of transferring of debits and credits from the journal to the ledger accounts is called posting. Posting is necessary as it summarizes all the transactions relating to the account at one place and also shows how transactions have changed the account balances. Ledger posting is entering information in the ledger in respective accounts from the journal for individual records. The account debited is posted to the debit side and the account credited is posted to the credit side of the same account. This process is carried throughout the year, and at the end of the financial year, the ledger accounts are closed and are totaled and balanced. This process is called the balancing of the ledger account. Let us now learn the mechanics of the posting. The steps involved in the posting of an account debited in a journal entry are: Step 1 is identify the account to be debited in the ledger. Step 2 is enter the date of the transaction in the date column on the debit side of the account. Step 3 is write the name of the account which has been credited in the respective entry in the particular column on the debit side of the account as by writing the word to followed by the name of the account to be credited. Step 4 is record the page number of the journal where the entry exists in the journal folio column. Step 5 is enter the relevant amount in the amount column on the debit side. In this slide, we will learn the steps involved in the posting of an account credited in the journal entry. Step 1 is identify the amount to be credited in the ledger. Step 2 is enter the date of the transaction in the date column on the credit side of the account. Step 3 is write the name of the account which has been debited in the respective entry in the particulars column on the debit side of the account by writing the word by followed by the name of the account to be debited. Step 4 is record the page number of the journal where the entry exists in the journal folio column. Step 5 is enter the relevant amount in the amount column on the credit side. Let us understand the posting of a simple journal entry with the illustration displayed on your screen. On July 1st, 2024, goods worth $20,000 purchased against the payment made by check. Now the journal entry for this transaction will be debit purchase account and credit bank account with $20,000. In this transaction, the two ledger accounts affected are purchase account and bank account. Therefore, this journal entry will be posted in the ledger accounts of purchase account and bank account as displayed on your screens. Since the purchase account is debited in the journal entry, the entry will be posted on the debit side of the purchase account by writing to bank account and an amount of 20,000 will be posted. Now the second account of the transaction, which is bank account, is credited. Therefore, the entry will be posted on the credit side of the bank account by writing buy purchase account and an amount of $20,000 will be posted. In this slide, let us learn the posting of a compound entry with the illustration displayed on your screens. On 1st July 2024, Tolly paid Molly $19,500 in settlement of $20,000 outstanding. Pass the journal entry and post to the ledger accounts. The three accounts which are affected by this transaction are Molly's account, bank account, and discount received account. Bank account is an asset account. As per asset account rule, credit asset when decreases. Therefore, bank account will be credited with $19,500 being the amount actually paid. Discount received is an income account, and as per income account rule, credit income account when it increases. Therefore, interest received account is credited with $500. Molly's account being a creditor is a liability account. As per liability account rule, debit liability account when it decreases. Therefore, Molly's account is debited with the amount of $20,000. Let us understand the posting to ledger accounts. Molly's account will appear as displayed on your screen. In the journal entry, Molly's account is debited with $20,000. Therefore, the entry will be posted on the debit side of Molly's account by writing to bank account and to discount received account with the respective values of $19,500 and $500. In the bank account, the entry will be posted on the credit side by writing by Molly account and an amount of $19,500 will be posted. In the discount received account, the entry will be posted on the credit side by writing by Molly account and an amount of $500 will be posted. In this slide, we will learn the posting of the journal entries in the ledger accounts of sales, cash, and bad debts. Journal entry for cash sales is on your screens. The two accounts affected are cash account and sales account, and the entry is passed by debiting cash account and crediting sales account with $2,000. In the second entry, where bad debts are recovered, cash account is debited and bad debts recovered account is credited. The entry is passed for $150. Let us understand how the above entries are posted in the respective ledger accounts. First, in cash account. In the first entry of cash sales, since cash account is debited, the entry will be posted on the debit side of the cash account with $2,000 by writing the words to sales account. The entry is posted in the cash ledger account on the date of the transaction. Since sales account is credited, the entry will be posted on the credit side of the sales account with $2,000 by writing the words by cash account. The entry is posted in the sales ledger account on the date of the transaction. Now in the second journal entry, cash account is debited with amount of bad debts recovered. This entry will also be posted on the debit side of the cash account with $150 by writing the words to bad debts recovered account. The entry is posted on 4th of April 24, which is the date of the transaction. The bad debts recovered being the income is credited to the bad debts recovered account. Therefore, this entry will be posted on the credit side of the ledger account of bad debts recovered account with $150 by writing the words by cash account. The entry is posted on 4th of April, which is the date of the transaction. Let us now learn about the opening journal entry. Every business close their books of accounts at the end of each accounting year due to the accounting period concept. In this process, nominal accounts under traditional classification of accounts or expense and income accounts under modern classification of accounts are closed by transferring them to the trading or the profit and loss account. Whereas personal and real accounts under the traditional classification of accounts, or we can say assets, liabilities, and capital accounts under modern classification of accounts are carried forward to the next accounting year. These become the opening balance of the next accounting year. The first entry in the journal book is passed to record the closing balances of the previous year, and it is called the opening journal entry. The balance sheet prepared at the end of the accounting year shows the closing balances of each of the asset and liability account. It forms the basis of opening entry. If capital is not given in the question, it is calculated by applying the accounting equation assets are equal to liabilities plus capital, or capital is equal to assets minus liabilities. Let us further understand the opening journal entry with an illustration. A specimen of a balance sheet of a business as on 31st December 2024 is displayed on your screens. Left hand side of the balance sheet is liability side. On liability side, we have sundry creditors of $24,000 and capital of $70,000, making a total of $94,000. Right hand side of the balance sheet is asset side. On the asset side, we have closing balances of cash in hand $4,000, cash at bank $15,000, sundry debtors $5,000, closing stock of $20,000, and plant and machinery of $50,000, making a total of $94,000 of the asset side. Accounts appearing on the liability side of the balance sheet have credit balance, and accounts appearing on the asset side have debit balance. The opening journal entry is passed on the first day of the new accounting year, which in our illustration is 1st of January 2025. All the asset accounts are picked from the asset side of the previous year's balance sheet and are recorded to the debit side of the respective accounts as shown on your screens. Similarly, all the liability accounts are picked from the liability side of the balance sheet and are recorded to the credit side of the respective accounts as shown on your screens. In continuation to the previous slide, let us now understand how the opening entry as on 1st of January 25 as displayed on your screen will be posted to the respective ledger accounts. First is cash account. In the cash account, entry will be posted on 1st of January for $4,000 on the debit side by writing the words to balance brought down. In bank account also, the entry will be posted on the debit side on 1st of January for $15,000 by writing the words to balance brought down. In the sundry debtors account, entry is posted on the debit side on 1st of January 25 for $5,000 by writing the words to balance brought down. Let us continue our learning of the ledger posting with the other opening entry balances. In the plant and machinery account, entry is posted on 1st of January for $50,000 by writing the words to balance brought down. Now in the sundry creditors account, the entry is posted on 1st of January on the credit side for $24,000 by writing the words by balance brought down. In the capital account, the entry is posted on 1st of January on the credit side for $70,000 by writing the words by balance brought down. In this slide, we will learn the concept of balancing a ledger account at the end of an accounting period. After posting the transactions from journal to ledger, all the accounts are balanced as and when required by the business in journal, but at the end of the accounting period in particular. Balancing an account means that the two sides of an account are totaled and the difference in the total of the sides is written on the side whose total is less. For example, if the total of the debit side is more than the total of the credit side of an account, the difference of amount will be recorded as balance carried down on the credit side and vice versa on the debit side. If the total of the debit side of an account is more than the total of the credit side, it means that the account has debit balance, and if the total of the credit side of an account is more than it shows the credit balance. Let us now understand the treatment of the opening balance on the first day of a new accounting period. If an account is having a debit balance at the last day of the accounting period, the debit balance is then written on the first day of the new accounting year on the debit side of the ledger account as to balance brought down or to balance B oblique D, which becomes the opening balance of the new accounting period. Now, if an account is having a credit balance at the last day of the accounting period, the credit balance is then written on the first day of the new accounting year on the credit side of the ledger account as to balance brought down or to balance B oblique D, which becomes the opening balance of the new accounting period. We have learned that the closing balances of all the asset accounts, liabilities account and capital account are brought down as opening balances on the first day of the new accounting period. Asset accounts are by nature have debit balance, whereas the liability accounts and the capital accounts are always having a credit balance. For more clarity, let us understand the process of balancing ledger accounts with the help of the flowchart. We start the account balancing process by totaling both the sides of a ledger account. Then find out the difference between the two sides. If the debit side total is more than the credit side total, write the difference on the credit side as by balance carried down. Now, if the credit side total is more than the debit side total, write the difference on the debit side as to balance carried down. The above process will ensure that the total of both debit and credit side is equal. The closing balance on the last day of an accounting period will be brought forward as opening balance on the first day of the new accounting period, or if the balancing of an account is done during any day of the accounting period, balance will be brought forward on the next day. If the closing balance of a ledger account is debit, then write on the debit side as to balance brought down on the first day of the next accounting period. And if the closing balance of a ledger account is credit, then write on the credit side as by balance brought down on the first day of the accounting period. Let us understand the concept of balancing of an account with an illustration of a cash account for the period 1st April 24 to 30th April 24. Cash being an asset account will be debited when increase and will be credited when decrease. The left hand side of a account is debit side and is denoted by the letter DR, and the right hand side of the account is credit side and is denoted by the letter CR. Left hand side of the cash account, which is debit side, has an opening balance of 50,000. All the transactions which result into increase in the cash balance are recorded on the left hand side of the cash account. In this example, the transactions which increases the cash of the business are cash sales of goods 75,000, collection from debtors 80,000, commission received 20,000, advance received from the customer 15,000, cash received from the sale of old delivery vehicle 40,000, and the capital contributed by the owner 100,000. And on the right hand side of the cash account, all the cash transactions which results into the decrease in the cash balance are recorded. Staff salary 80,000, office rent 40,000, cash purchases 50,000, payment to creditors 60,000, withdrawal by the owner 20,000, and cash deposited into the bank 75,000. In this cash account example, when from the total cash of 380,000, all the payments of the cash are deducted, we are left with a cash balance of 55,000. Since in this cash account example, credit side is shorter than the debit side, the excess of the total debits of 380,000 minus total credits, the difference amounting to 55,000 shall be entered on the credit side of the cash account by writing by balance carried down with date. This carried down balance of 55,000 is carried forward to the immediate next date, which in this example is 1st of May 24, by writing to balance brought down. Cash account shows a closing balance in hand of 55,000 as on 30th April 23, and it also shows the brought down balance of 55,000 as on 1st of May 24. I sincerely hope we have understood with this example the concept of balancing of an account and the terms balance carried down and the balance brought down and their relevance. Important facts which you should always remember for balancing an account are: only personal and real accounts are balanced. Nominal accounts are not balanced. Nominal accounts are totaled and are closed by transferring them to profit and loss account. Balances in the asset, liability and capital account are transferred to the balance sheet. The personal and real accounts are balanced and their balances are carried forward to the next financial year. Let us learn the significance of debit and credit balance in accounts. Credit balance in capital account means the amount due to the owner of the business. Credit balance in bank account, supplier account or other similar accounts means the amount payable by the business. They are the liabilities of the business. Debit balance in cash account means the cash in hand. Balance in bank account means the cash at bank. Balance in debtors account means the amount receivable against sales. Balance in building account, furniture account means the value of the assets owned by the business. Credit balance in sales account, interest received account, discount received account, etc. means the income earned by the business. Debit balance in rent account, salary account, interest paid account, etc. means the expenses incurred by the business. An account with debit balance is either an asset account or an expense account. An account with credit balance in is either an income account or a liability account or a capital account. Let us now try and prepare a creditor account of Mr. Polly by considering the following transactions. A creditor is a liability of the business. Liability by nature have a credit balance. Therefore, in this illustration, the opening balance as on 1st of April 24 in Mr. Polly's account is 12,500. Transaction T1 is business purchased 500 kg of sugar worth 125,000 on credit from Mr. Polly. Now with this transaction, the liability of the business will increase as an amount of 125,000 is payable to Mr. Polly. As per liability account rule, liability account will be credited when liability increases. Therefore, the transaction of 125,000 will be recorded on the left hand side, that is the credit side of Mr. Polly's account. Transaction T2 is on 30th April 24, an amount of 100,000 cash is paid to Mr. Polly against an outstanding payable amount. With this payment of 100,000 to Mr. Polly, the outstanding balance of Mr. Polly will be reduced by 100,000 and thus the liability of the business will also get reduced by 100,000. As per liability account rule, the liability account will be debited when the liability reduces. Therefore, this transaction of 100,000 will be recorded on the right hand side, that is the debit side of Mr. Polly's account. Transaction T3 is on 15th of June 24, 50 kg of sugar was returned to Mr. Polly. The cost of the sugar returned is 12,500. Since the sugar was 12,500 is returned to Mr. Polly, this amount is no more payable to him. Therefore, his outstanding balance will get reduced by 12,500. As per liability account rule, the liability account is debited when they reduces. Thus, Mr. Polly's account will be debited by 12,500. T4 transaction is on 30th June 24. Again, 300 kg of sugar worth 75,000 was purchased. With this transaction, the liability of the business will increase. Therefore, Mr. Polly's account will be credited by 75,000. T5 transaction is a discount of 5,000 is received from Mr. Polly. The amount of discount given by Mr. Polly will reduce the liability of the business. Therefore, Mr. Polly's account will be debited by 5,000. Now, in this creditor account illustration, the credit side of the account is greater than the debit side. The total of credit side of the account comes to 212,500. When the total of the debit side transactions is deducted from the credit side total of 212,500, we will get the balance carried down 95,000 as on 30th June 24. The debit side total will also be 212,500 and thus the account will be balanced. The balance carried down as on 30th June 24 will become the balance brought down as on 1st of July 24. In this session, we will attempt one word answer for questions. Question number 1 is, what is the primary book of accounts? And the answer is ledger. Question number 2, what type of system does a ledger follow? The answer is double entry system. Question number 3, which ledger records personal accounts? The answer is subsidiary ledger. Question number 4, what is another name for main ledger? The answer is journal ledger. Question number 5, where are cash transactions recorded? The answer is cash book. Question number 6, what does a ledger contain? The answer is accounts. Question number 7, what is the left side of a ledger called? The answer is debit side. Question number 8, what is the right side of the ledger called? The answer is credit side. Question number 9, what is the final balance in a ledger called? The answer is closing balance. Question number 10 is, what is the first entry in a ledger called? The answer is opening entry. Question number 11. What ensures accuracy before financial statements? The correct word is trial balance. Question number 12. What is the process of transferring journal entries to the ledger called? And the correct word is posting. In this section, we will address few short questions and answers. Question number 13 is, what is the meaning of ledger? The answer is, ledger is a book which has in a summarized and classified form a permanent record of all the transactions. Question number 14 is, what are the types of ledgers? The answer is, the main type of ledgers are journal ledger that contains all the accounts of the business, subsidiary ledger which includes accounts payable ledger, accounts receivable ledger, etc. Question number 15 is, what is the purpose of a ledger? The answer is, the ledger helps organize and summarize all financial transactions, providing a basis for preparing financial statements. In my upcoming video on 3rd May 2025 of Part 2 of Chapter 9, the Ledger, we will be covering 13 more topics as displayed on your screens. The lesson is full of practical illustrations related to the posting of journal entries to several ledger accounts. If you enjoy the content of my channel and appreciate my teaching style, please subscribe, share and like my YouTube channel at the rate Accounting Buddy NB. Thank you and goodbye for now.